Amongst others, anticipating more takeover activity in this market, as we mentioned, with stocks at some of their cheapest levels in a year at the moment. Certainly, analysts are saying current valuations mean local firms are particularly attractive for strategic buyers, as long as they do, of course, have a long-term investment horizon. Well, Stephen Nash is from investment bank Madison & Williams on a roadshow in Australia at the moment, and he joins us now from our Sydney studio. As we talk locally, Stephen, about the possibility of takeover activity, are you seeing interest actually in Australian companies from offshore players?
Absolutely. I mean, if you look at the balance sheets of corporates in the United States, it's the cash levels are some of the highest they've ever been, and you are seeing, particularly in the healthcare space, many pharmaceutical companies with blockbuster drugs that are going off patent, and they're looking for opportunities, certainly in emerging growth in biotechnology space. And Australia has quite a bit of life sciences companies that I would say are looking pretty attractive right now.
Do you think the Australian dollar deters any of them when they're looking at M&A deals?
It certainly does put some stress on the overall valuation of the deals. Some transactions that we're seeing go through, companies will put on a pretty massive hedge alongside the purchase to basically mitigate some of the risk of a decline in the Australian dollar, because that is definitely something that I think that people are looking at right now in terms of overall global markets.
And are they betting that the Australian dollar stays high? There's kind of cracks appearing the last few days for us, but what is the bet that they're making on the Australian dollar as they kind of look at those deals?
I think that they want to be market neutral right now. They want the companies, and they want to try to take the exchange risk out of the transactions. Companies are poised to do well, and that would, and that's really what they're after. They're not after a play on a currency, quite frankly. So. There are thoughts both ways. One is that the Australian dollar has been overbought, and there's quite a bit of focus right now on the situation in Greece, as everybody knows, and that creates a lot of uncertainty in the currency markets. So I would say that smart money, and particularly corporate money now, isn't playing the currency game. They're looking for good companies that can add value to their portfolios and be accretive to earnings.
As you will have heard while you've been in Australia, our share market has actually underperformed a lot of other major developed markets and their equity markets. Some of that has been offshore investors basically pulling out of the Australian share market. What are you seeing around the appetite for US investors to be in our market here?
Sure. I mean, we have seen some sell-off, and given the strength of the Australian dollar, but overall, what I would say is fundamentally the things that make Australia attractive to institutions in the United States haven't changed, and we are seeing increasing interest, certainly in energy and international energy, and have been doing a number of actual transactions with Australian companies that are looking to raise capital right now from U.S. institutional investors. So. Despite what has been, some sell-off, we still see, a massive amount of interest. We see U.S. institutions now continuing to increase allocations to overseas equities. Australia for a long time was getting the benefit of that. While the Australian dollar perhaps is a bit overbought, that may have had a little bit of a pullback. But that said, I think the long-term prospects for this market are very good, and particularly with the tie-in to China.
I know you mentioned that healthcare space earlier, but do you find most of the interest is actually in the mining and the resources side of things for our market?
I would say yes. I mean that healthcare is only a very small part of your market. I mean, certainly the lion's share of activity is happening in mining, and we are seeing very strong interest in the resource play, given the position to China, and the impending demand that the Chinese market can avail to the Australian companies.
It's interesting because we've had this carbon tax debate ongoing, as you'll be hearing in Australia. We've had a mining tax in the last year and a bit as well. I know that Vale, for one, has said that it would actually prefer to invest in Africa than Australia because of the unpredictable nature of investing here in Australia. How do investors that you speak to or that you're in contact to perceive the level of risk of investing in Australian resources?
Look, I mean, you hit on a massive point there. I mean, the fact that that Vale did move or is moving ahead with major projects in Africa over Australia, given the political environment, is something that is a real threat to this market. And what the market does not like is uncertainty, particularly around a political scheme that has yet to be defined. So I would say that is something that very much smart money and major companies that have operations globally are looking at before they move forward. You have a number of services companies that are going to they're Australian corporates that are basically waiting for deals to progress, given that there is no yet determined scheme for the taxes that are going to be charged. So everybody is watching closely. There is an opportunity here, but with continuing political uncertainty, that can be a detriment to the Australian market.
Speaking of waiting for deals to progress, private equity-backed IPOs here in Australia, there's some scepticism about whether the success of these IPOs can be sustained. That's kind of a local discussion here. It's come to a bit of a grinding halt, actually. But there's been $58 billion in withdrawn IPOs across Asia, and I know that weakness extends across the globe as well. Are companies you speak with seeing these as warning signs? What's wrong with the IPO market at the moment?
The IPO market, well, one of the issues is the scale and size needed now to justify an IPO, and the amount of and the potential liquidity, risk that a smaller deal would have. So I would say that that is one of the key problems with today's IPO market is the pure size that a company must have in order to go public, and it's getting larger, not smaller. So the private equity backed companies that are relatively smaller, they're being forced to stay in portfolios of the private equity companies longer, and M&A is becoming more of an exit than an IPO, given where the markets have been. That said, I mean, there have been a tremendous amount of very successful IPOs in certain sectors this year, namely healthcare. You had HCA raise $3.8 billion in a healthcare IPO in March of this year. Broadly, healthcare IPOs have radically outperformed the market over the last 12 months, up about 30% or so. So, there are certain sectors that there is an appetite right now for an IPO. Others, clearly, as you mentioned, the companies that are backed by private equity and perhaps smaller, the window is not open quite yet.
We have also seen today, Stephen, this tiny sliver of Facebook bought by GSV. It values Facebook at $70 billion at the moment. You talked about smart money before. We hear that some of the smart money is going into these big tech stocks and these social media sites. Where do you think smart money is and should be going?
I mean, right now it's interesting. I think that is a quite. I mean, it's very difficult to say and comment on the valuation of Facebook in terms of where smart money should be going. What we see the institutions looking at are major macroeconomic trends that are moving markets, and smart money follows investment. And if you look at the international markets, Brazil right now is really poised for a massive amount of investment. And certainly with the capital being raised there, in the nearly $100 billion in the last you call it 12 months. I mean, you're seeing a massive opportunity, given the upcoming World Cup next year and the 2016 Olympics that will be happening in that country, and the amount of money that needs to be spent to get the country even ready is massive. So we do see a lot of smart money looking for opportunities there. We see smart money also looking for opportunities in Latin America and Colombia. I would say that it's not necessarily companies that right now make sense. It's more the macro plays, and then finding the companies that are going to benefit with the macro environment.
Stephen Nash, it's been an absolute privilege to talk to you today. Thank you so much for joining us on the program. Thank you.
Thank you.
From Madison and Williams. And we'll take a quick break. Jack Scoble from Chicago with a look at these soft commodities overnight. Some big moves around the macroeconomic worries. Stay with us.